Welcome to Investing 101, Episode 1. This series teaches you the fundamentals of investing. Today, we answer two questions. Why should you invest? And what are emergency funds? Money loses value over time. This is called inflation. If you keep $10,000 in cash, it buys less next year than it does today. Investing helps your money grow faster than inflation. When you invest, your money works for you. You earn returns. Those returns earn their own returns. This is called compound interest, and it's powerful. Consider this. If you save $500 monthly for 20 years in a regular savings account earning 0.5%, you'll have about $126,000. But if you invest that same $500 monthly at 7% average return, you'll have about $255,000. That's almost $130,000 more just from investing instead of saving. Investing gives your money the chance to grow significantly over time. Before you invest, you need an emergency fund. This is money set aside for unexpected expenses, car repairs, medical bills, job loss. Your emergency fund should cover 3 to 6 months of living expenses. If your monthly expenses are $3,000, your emergency fund should be $9,000 to $18,000. Keep your emergency fund in a high-yield savings account. This is different from investing. It's safe, accessible, and earns interest. Currently, high-yield savings accounts earn around 4 to 5% annually. Here's the order. First, build your emergency fund to 3 months of expenses. Second, start investing for long-term goals. Third, increase your emergency fund to 6 months. Why this order? If you invest all your money and face an emergency, you might have to sell investments at a loss. An emergency fund prevents this. Once your emergency fund is complete, you're ready to invest. In the next episode, we'll calculate how much you need to retire. See you then. Don't forget to subscribe for more videos like this. Click the links below to start investing today.
Welcome to Investing 101, Episode 2. How much money do you need to retire? The answer depends on your lifestyle. Let's look at 3 scenarios. Financial experts use the 25 times rule. Multiply your annual expenses by 25. That's your retirement number. Why 25? It's based on the 4% rule. You can safely withdraw 4% of your retirement savings annually without running out of money. Let's see 3 examples. Situation 1. Conservative lifestyle. Annual expenses are $40,000. The retirement amount needed is $1 million. You can withdraw $40,000 yearly from your $1 million. Situation 2. Moderate lifestyle. Annual expenses, $60,000. Retirement needed is $1,500,000. You withdraw $60,000 yearly from your $1,500,000. Situation 3. Higher lifestyle. Annual expenses is $80,000. Retirement needed is $2 million. You withdraw $80,000 yearly from your $2 million. Notice, doubling your expenses doubles your retirement number. This is linear. Your retirement goal depends directly on how you want to live. To find your retirement number, Step 1. Calculate your annual expenses. Add up housing, food, transportation, entertainment, and healthcare. Step 2. Multiply by 25. That's your target. Example. If you spend $50,000 yearly, you need $1,250,000 to retire. This seems large, but remember, you have decades to save. Compound interest does the heavy lifting. We'll show you how in the next episode. Your retirement number isn't fixed. As your life changes, recalculate it. But having a target keeps you focused. Now you know your retirement goal. Next, we'll show you how compound interest makes reaching it possible and how to do it using cost averaging. See you then. Don't forget to subscribe for more videos like this. Click the links below to start investing today.
Welcome to Investing 101, Episode 3. Compound interest is the most powerful force in investing. Albert Einstein called it the 8th wonder of the world. Let's see why. Compound interest means earning returns on your returns. Your money grows exponentially, not linearly. Here's the difference. With 1-year growth, you earn the same amount each year. Exponential growth, you earn more each year because your base grows. Here's an example. Say you invested $10,000 at a 7% annual return. Year 1 earns you $700. totaling $10,700. Year 2 earns you $749. That's 7% of the $10,700 from year 1, totaling $11,449. Year 3 earns you $801, totaling $12,250. Notice, year 3 earnings of $801 exceeds year 1 earnings of $700. Your money accelerates. Let's take a look at 4 different scenarios of ways to invest your money, and let's see what happens. Scenario 1. You invest $50 weekly, which is about $217 monthly, at a 7% return. After 20 years, you'll have $113,041, of which you invested $52,080, meaning you've earned $60,961. Once again, your money has doubled. Scenario 2, you're now able to invest $500 a month at the 7% return. Your total after 20 years is $260,463, of which you invested $120,000. That means your interest that you have made is $140,463. You earn more than you invested. With scenario 3, you're able to get 10% interest instead of 7%, still doing $500 monthly. The total after 20 years, you will have $379,648, of which you invested $120,000. This means that interest you have earned is $259,684. Higher interest rates creates higher returns, which creates dramatically higher totals. In scenario 4, you start with a large lump sum. You start with $5,000 invested, and then you do $300 monthly at 7% return. After 20 years, you will have $176,472, which $77,000 you invested. Your interest was $99,472. Starting early gives you a huge head start. Now let's talk about cost averaging. Cost averaging is a strategy that works with compound interest. It means investing the same amount regularly, regardless of price. Here's an example. You invest $500 monthly into a fund. Month 1, the price per share is $100, and you buy 5 shares. Month 2, it drops to $80 per share. You buy 6.25 shares. Month 3, the price rises to $90 a share, in which you buy 5.56 shares. The total you own is 16.81 shares for $1,500. Your average cost per share is $89.23. If you have invested $1,500 in month 1 at $100 per share, you would only have 15 shares. Cost averaging gave you an extra 1.81 shares by spreading out your purchases. When prices drop, you buy more shares. When prices rise, you buy fewer. This smooths out volatility. Cost averaging removes emotion from investing. You invest the same amount every month automatically. Compound interest and cost averaging are your allies. Next, we'll learn about the Rule of 72, a simple tool to predict growth. See you then.
Don't forget to subscribe for more videos like this. Click the links below to start investing today.
Investing 101, Episode 4, The Rule of 72. The Rule of 72 is a simple math trick. It tells you how long your money takes to double. The formula is simple. Divide 72 by your annual return rate. The result is the number of years to double your money. Examples. At 3% annual return, 72 divided by 3 is 24 years to double. At 5% annual return, 72 divided by 5 is 14.4 years to double. At 7% annual return, 72 divided by 7 is 10.3 years to double. At 10% annual return, 72 divided by 10 is 7.2 years to double. At 12% annual return, 12 is 6 years to double. Notice higher returns mean faster doubling. A 3% difference between 7% and 10% cuts your doubling time from 10 years to 7 years. Let's apply this to real money. You invest $10,000 at 7% annual return. Using the Rule of 72, your money doubles in 10.3 years. After 10.3 years, your investment is now $20,000. After 20.6 years, it's $40,000. And after 30.9 years, it's $80,000. You invested $10,000 once, and after 31 years, it became $80,000. That's the power of doubling. Now imagine you invest $500 monthly at 7% return for 30 years. Your total grows to over $600,000. The rule of 72 helps you visualize this growth. The rule of 72 also shows why small differences in returns matter. A 2% difference between 7% and 9% might seem small, but at 9%, your money doubles in 8 years instead of 10. That's 2 years faster. Over decades, this compounds into significant differences. This is why choosing the right investments matters. We'll explore that next. The rule of 72 is your mental math tool for growth. Next, we'll learn what stocks are and how they work. See you then.
Don't forget to subscribe for more videos like this. Click the links below to start investing today.
A stock is a piece of ownership in a company. When you buy stock, you become a part owner. Let's understand how. Companies need money to grow. They can borrow from banks or sell ownership pieces called shares. When you buy one share of Apple stock, you own a tiny piece of Apple. If Apple has 16 billion shares outstanding and you own one share, you own 1/16th billionth of the company. Companies divide ownership into shares to make it affordable. Instead of needing $1 billion to own a piece of Apple, you can own a piece for a few $100s. Stocks trade on exchanges like the New York Stock Exchange. Prices change based on supply and demand. If many people want to buy Apple stock, the price rises. If many people want to sell, the price falls. You make money from stocks in two ways. First, capital gains. You buy at $100 and sell at $150. You profit $50. Second, dividends. Some companies pay shareholders a portion of profits quarterly or annually. You earn money without selling. Now let's talk about stock slices. Modern brokers offer fractional shares. This means you don't need to buy a whole share. Example, Tesla stock costs $250 per share. With fractional shares, you can invest $50 and own zero point 0.2 shares. This democratizes investing. You can own pieces of expensive companies with small amounts of money. Fractional shares work like regular shares. If you own 0.2 shares and the stock rises 10%, your 0.2 shares gain 10% too. Fractional shares also enable cost averaging. You can invest $100 monthly in the same stock, buying fractional shares each month. This smooths out price volatility. Stocks are volatile. Prices fluctuate daily. But historically, the stock market averages 10% annual returns over long periods. This volatility is why long-term investing matters. Short-term fluctuations smooth out over decades. Stocks are ownership pieces in companies. Next, we'll compare stocks to bonds, treasury bills, and savings accounts. See you then.
Don't forget to subscribe for more videos like this. Click the links below to start investing today.
Stocks are ownership. Bonds are lending. Let us understand the difference and when to use each. A bond is a loan you give to a company or government. They promise to pay you back with interest. When you buy a corporate bond, you lend money to a company. They pay you interest, called a coupon, usually semi-annually. At maturity, they return your principal. Example, you buy a 10-year corporate bond for $1,000 paying 5% annually. You receive $50 yearly for 10 years. After 10 years, you get your $1,000 back. Bonds are less volatile than stocks. Your return is predictable, but they also offer lower returns. Stocks average 10% annually. Bonds average 4 to 6%. Bonds are appropriate for conservative investors or money you need within 5 to 10 years. They are safer but slower. Treasury bills are short-term government loans. The United States government borrows money by issuing treasury bills, notes, and bonds. Treasury bills mature in less than 1 year. Treasury notes mature in 2 to 10 years. Treasury bonds mature in 20 to 30 years. Treasury bills are the safest investment. The United States government backs them. Default risk is essentially zero. Currently, Treasury bills yield around 4 to 5% annually. This is higher than savings accounts but lower than stocks. Treasury bills are appropriate for emergency funds or money you need within 1 year. They are safe and liquid. High-yield savings accounts are bank accounts earning higher interest than regular savings accounts. Regular savings accounts earn 0.01% annually. High-yield savings accounts earn 4 to 5% annually. High-yield savings accounts are Federal Deposit Insurance Corporation insured up to $250,000. This means if the bank fails, the government protects your money. High-yield savings accounts are appropriate for emergency funds. They are safe, liquid, and accessible. Comparison: stocks, 10% average return, high volatility, 20-plus year horizon. Bonds, 4 to 6% return, low volatility, 5 to 10 year horizon. Treasury bills, 4 to 5% return, no volatility, less than 1 year horizon. High yield savings, 4 to 5% return, no volatility, immediate access. Use each for its purpose. Emergency funds go in high yield savings. Long-term retirement goes in stocks. Medium-term goals go in bonds or treasury bills. Different investments serve different purposes. Next, we will learn about exchange-traded funds and mutual funds, which are ways to own many stocks at once. See you then.
Don't forget to subscribe for more videos like this. Click the links below to start investing today.
Welcome to Investing 101. Episode 7. ETFs versus mutual funds. Owning individual stocks can feel risky. What if you pick the wrong ones? That's where ETFs and mutual funds come in. They solve this problem by letting you own many stocks at once. What is an ETF? ETF stands for Exchange Traded Fund. An ETF is simply a basket of stocks bundled together. For example, the SPY ETF owns 500 large United States companies. When you buy one share of SPY, you are buying a tiny piece of all 500 companies at the same time. ETFs trade just like stocks. You can buy and sell them during market hours, and prices change throughout the day. ETFs are passive investments, meaning they follow an index. The S&P 500 index contains 500 large companies, and SPY tracks that index. When the index moves, SPY moves with it. ETFs also have low fees. Typically, fees range from 0.03 to 0.20% per year. That means if you invest $10,000 in an ETF, it may only cost you $3 to $20 annually. ETFs are also tax efficient. They rarely distribute capital gains to shareholders. What is a mutual fund? A mutual fund is also a basket of stocks, but it works a little differently. Most mutual funds are actively managed. A manager chooses which stocks to buy and sell, trying to beat the market. Because of this, mutual funds trade only once per day after the market closes. You cannot buy or sell them during the day. Mutual funds also tend to have higher fees. Typically, fees range from 0.5 to 2% annually. On a $10,000 investment, that can cost you $50 to $200 every year. Mutual funds are also less tax efficient. Frequent trading creates capital gains, which are passed on to shareholders. Active managers try to beat the market, but historically, most fail. Studies show that 80 to 90% of active managers underperform their index over a 15-year period. In other words, you often pay more and get worse results. ETFs versus mutual funds. Here's the comparison. ETFs are passively managed, they trade throughout the day, they have low fees, they are tax efficient, and they are better for most investors. Mutual funds are actively managed. They trade once per day, they have higher fees. They are less tax efficient, and they rarely outperform their indexes. For beginners, ETFs are usually the better choice. Lower fees mean more of your money stays invested. Tax efficiency means more growth over time, and simplicity means less stress. Some popular beginner ETFs include SPY and VUO, which track the S&P 500, VTI, which covers the total United States market, and QQQ, which focuses heavily on technology companies. Start simple. Invest monthly. Let compound interest do the work. ETFs are your foundation. Next, we will explore retirement accounts, which are special accounts with powerful tax advantages. See you then.
Don't forget to subscribe for more videos like this. Click the links below to start investing today.
Welcome to Investing 101, Episode 8, Retirement Accounts. Introduction to retirement accounts and their tax advantages. Retirement accounts offer tax advantages. The government wants you to save for retirement, so it rewards you with tax breaks. Let's explore the main types. Understanding the 401k. Your employer-sponsored retirement account A. 401k is an employer-sponsored retirement account. Your employer offers it as a benefit. You contribute pre-tax money. This reduces your taxable income. For example, if you earn $60,000 and contribute $10,000 to a 401k, you pay taxes on $50,000. Many employers match contributions. If you contribute 3%, they contribute 3%. This is free money. Always contribute enough to get the full match. Money grows tax-free inside the account. You do not pay taxes on gains until withdrawal. You can withdraw at age 59 and a half without penalty. Before that, you pay a 10% penalty plus taxes. The 2024 contribution limit is $23,500 annually. Exploring the traditional IRA. Open your own retirement account. An IRA is an individual retirement account. You open it yourself, not through an employer. A traditional IRA works like a 401k. Contributions are pre-tax. Money grows tax-free. You pay taxes on withdrawals. You can withdraw at age 59 and a half without penalty. The 2024 contribution limit is $7,000 annually. Traditional IRAs are good if your employer does not offer a 401k. Explaining the Roth IRA, tax-free growth for life after work. A Roth IRA is an individual retirement account you open independently, not through an employer. With a Roth IRA, you contribute after-tax money. Your money grows tax-free and you do not pay taxes on withdrawals in retirement. You can withdraw at age 59 and a half without penalty. The 2024 contribution limit is $7,000 annually. Roth IRAs are beneficial if you expect to be in a higher tax bracket in retirement. Introducing the HSA, a powerful health and retirement savings tool. An HSA is a health savings account. It is triple tax advantaged. Contributions are made with pre-tax dollars. Growth is tax-free. Withdrawals for medical expenses are tax-free. You must have a high-deductible health plan to open an HSA. The 2024 contribution limit is $4,150 for individuals. HSAs are underutilized. Many people use them only for current medical expenses. However, you can invest HSA money and let it grow. It is essentially a retirement account disguised as a medical account. After age 65, you can withdraw for any reason. You pay taxes on non-medical withdrawals, but no penalty. How to prioritize your retirement contributions for maximum benefits. Start by contributing to your 401k up to the employer match. Next, max out your Roth IRA at $7,000. Then, max out your HSA if available up to $4,150. Return to your 401k for contributions beyond any employer match. Finally, invest in taxable accounts. This order maximizes tax advantages. Final thoughts on retirement accounts. Retirement accounts are tax advantaged. Use them. Next, we will summarize everything and create your action plan. See you then.
Don't forget to subscribe for more videos like this. Click the links below to start investing today.
Welcome to Investing 101, Episode 9, Summary and Action Plan. We've covered a lot. Let's summarize and create your action plan. Episode 1, Build an emergency fund first. 3 to 6 months of expenses in a high-yield savings account. Episode 2, Calculate your retirement number. Multiply annual expenses by 25. Episode 3, Compound interest and cost averaging are your allies. Invest regularly regardless of price. Episode 4, The Rule of 72 predicts doubling time. Divide 72 by your return rate. Episode 5, Stocks are ownership pieces. Fractional shares make them accessible. Episode 6, Different investments serve different purposes. Stocks for long-term, bonds for medium-term, savings for short-term. Episode 7, ETFs are superior to mutual funds for most investors. Lower fees, tax-efficient, passive. Episode 8, Retirement accounts offer tax advantages. Prioritize 401k match, then Roth IRA, then HSA. Here's how to get started. Step 1. Calculate your monthly expenses. Add housing, food, transportation, entertainment, healthcare. Step 2. Build your emergency fund. Save 3 months of expenses in a high-yield savings account. Step 3. Calculate your retirement number. Multiply annual expenses by 25. Step 4. Open a retirement account. If your employer offers a 401k, contribute to get the match. Open a Roth IRA. Step 5. Choose an ETF. Start with SPY, VTI, or VOO. These track broad market indexes. Step 6. Invest monthly. Set up automatic monthly investments. Start with what you can afford. $100 monthly is fine. Step 7. Increase contributions over time. As income grows, increase contributions. Step 8. Rebalance annually. Check your portfolio once yearly. Adjust if needed. Step 9. Don't panic during downturns. Market drops are normal. Stay invested. History shows recovery. Step 10. Review annually. Recalculate your retirement number. Adjust your plan as life changes. Investing isn't complicated. Start small. Be consistent. Let time work for you. Compound interest rewards patience. You've got this.
Don't forget to subscribe for more videos like this. Click the links below to start investing today.